Silver is spiking again. Just a few days ago, it surged to just under $39 per ounce, its highest level since 2011, and then it pulled back. And if history is any guide, that means something deeper is going on. Let's take a look. So silver touched $39 and then it pulled back. Every time silver has done this before, 1980, 2008, 2011, it wasn't just reacting to chaos, it was reflecting it, or more accurately, foreshadowing it. This isn't about noise in the market, it's about a metal that has consistently signaled when trust in the system begins to fray. And right now, silver is sending up flares. Today, we'll look at why silver's latest breakout might be more than just another price move, and we'll look at its history as a crisis barometer, unpack the recent drivers behind the 2025 surge, and explore what this means for the broader economic picture. Let's start with what silver has done before. In 1980, silver came within a breath of $50, and that surge coincided with sky-high inflation and the US dollar on the ropes. And back then, the government had to issue debt in foreign currencies because trust in the greenback had evaporated. The Fed responded with punishing interest rate hikes that triggered a deep recession. Silver, in hindsight, wasn't just along for the ride, it was reacting to visible cracks in the monetary system. Fast forward to 2011, and we saw a similar pattern. Silver once again raced towards that $50 mark as Europe's sovereign debt crisis gathered steam, and southern European bond yields were spiking. Banks looked shaky, and policymakers appeared paralyzed. While gold climbed steadily, silver spiked violently, amplifying the stress. In both episodes, silver acted like a seismograph. Unsteady hands dismissed it as speculative froth, but time and time again, these spikes have coincided with serious financial strain. They serve as reminders that silver's behavior is not random. It mirrors conditions few want to talk about until it is too late. And now, in 2025, we find ourselves watching another silver surge. Silver prices vaulted towards $39. COMEX September futures climbed even higher, with dislocations between spot and futures markets creating those juicy arbitrage spreads, and physical shortages re-emerged. Traders scrambled for deliverable supply, lease rates firmed, and chatter of delivery bottlenecks echoed earlier episodes. And what's different this time? Well, perhaps not much. The rally came just days after the US announced those sweeping 30% tariffs on imports from the EU and Mexico, so that alone would rattle markets. But silver, well, it seems to be digesting more than just trade policy. It seems to be expressing a kind of discomfort with a much broader shift in global confidence. Mexico is the world's largest silver producer. Tariff friction risks disrupting the flow of raw material into those refining markets. And meanwhile, China has been quietly tightening its controls on scrap exports, creating potential bottlenecks in those secondary supply chains. So the result? Well, a squeeze on physical supply, just as demand accelerates from both industrial and investment sources. ETF flows are one of the clearest windows into investor appetite. And right now, that appetite is ravenous. In the first half of 2025, more money flowed into silver ETFs than in all of 2024. And holdings now exceed 1.13 billion ounces, just 7% shy of the record set during that 21 Reddit-fueled silver squeeze. In June alone, nearly half of the 2025's inflows arrived, pushing the total value of holdings over $40 billion for the first time in history. These are not just passive flows, they are an active response to a shifting macro narrative. What's especially notable about this rally is who's participating. Yes, we have the short-term traders who are active. They are chasing those technical breakouts above 35, 37, targeting 40 and beyond. But the rally is not just about speculative momentum. It's being joined by institutions, sovereign entities, and long-term value investors. Now, in India, a market that's usually dominated by gold, silver is gaining traction. It's more affordable, it has outperformed gold in the year to date, and feels like a better value proposition in a high inflation, high debt world. Even in Europe, long dismissive investors are taking another look. In Germany, concerns over inflation and the euro's future are fueling a quiet accumulation. And then, of course, we have the geopolitical dimension. Russia has reportedly begun adding silver to its state reserve fund. While data is, of course, thin, the move fits this broader trend. BRICS nations seeking to diversify away from the US dollar. Gold is expensive, it's tightly held, and it's well monitored, whereas silver, well, that offers a more flexible path. If other central banks follow Russia's lead, the physical market could tighten even further. Now, this shift may signal rethinking of reserve composition globally. Silver, which has been long overlooked by monetary authorities, could well be positioning itself as a parallel store of value in a world where it's increasingly suspicious of debt-laden fiat currencies. And of course, one metric that always helps us to cut through this noise is the gold-silver ratio. It currently sits around 86, which is well above the 10-year average of about 70. And this means that silver remains cheap relative to gold, even after this rally. If the ratio simply reverted to historical norms without gold moving, well, silver would be valued at closer to $63 per ounce. Of course, inflation-adjusted comparisons paint an even starker picture. At its 1980 peak, silver's inflation-adjusted price was around $197. In 2011, that number was closer to $71. Today, we're at $38, still miles away from either level, and yet the macro backdrop, high inflation, geopolitical instability, monetary policy exhaustion, it all feels eerily familiar. Supply dynamics remain tight. According to the Silver Institute, 2025 will mark the 5th consecutive year where demand exceeds supply. Even if industrial demand has softened slightly from 24, consumption still outpaces production. Silver is no longer just a store of value. It's an input for everything, from solar panels and EVs to high-end electronics and aerospace components. Roughly 60% of all newly mined silver now goes directly into industry, up from around 50% a decade ago. And while some might view silver's volatility as a risk, others see it as a feature. In fact, silver is increasingly being targeted as a leverage bet on gold itself. When fear spikes, gold may rise first, but silver tends to catch up with a vengeance. And that leverage, coupled with tight liquidity, makes for explosive price action. None of this means silver is a perfect predictor. It doesn't ring a bell before every crisis. Sometimes it lags, sometimes it leads, but it responds to stress, especially the kind of stress that challenges confidence in fiat systems, bond markets, and central bank credibility. And what are we seeing now? Well, we're seeing inflation that refuses to go away. We are seeing sticky energy prices. We're seeing bond markets that are struggling to digest debt issuance. There is political uncertainty around tariffs, trade wars, and currency blocks. We've got central banks that have fewer levers left to pull, and silver responds to those dynamics not with speeches, but with movement. It reflects anxiety before consensus forms. It mirrors monetary dysfunction before the press catches up. Of course, it doesn't offer solutions. Instead, it demands attention. Even during panic, silver doesn't always behave like gold. In 2008 and 2020, when systemic fear hit, the gold-silver ratio spiked, hitting 127 at one point during the pandemic. Investors sold silver more aggressively than gold. But in the recovery phases, silver rebounded harder. And this duality, safe haven, growth proxy, makes silver uniquely responsive to the economic cycle. So let's be clear, we're not suggesting silver isn't being deliberately suppressed or manipulated. We're not saying there's no shadowy plot to contain its price. But what we are saying is that silver has a habit of flaring up when something beneath the surface is shifting. This is one of those times. The financial system feels brittle. Growth is uneven. Trust is thin. And silver, once again, is starting to stir. Investors would do well to pay attention, not because silver will solve all your problems, but because it's a signal that problems are already brewing. What silver is telling us right now is not complicated. It's saying that people are nervous, that faith in policy is cracking, that the world feels out of balance, and that the usual responses may not be enough this time. And if you're wondering about how you can embrace silver, perhaps like the other central banks are starting to, then why not head for the exit and download your exit plan now?